Hello and welcome to week 3 2021 of Portfolio Matters, and as you can see we are still stuck in lockdown and doing this over Zoom. Anyway, we will now cover the markets in the third week of 2021, but before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Right. So what happened during the week? Well, it was another eventful week. Joe Biden was sworn in as US president, and the first thing he did was propose a new $1.9 trillion stimulus program. It's getting to the point where $1 trillion is being thrown around like $1 billion used to be 10 years ago. Households are in line to get a further $1,400 check each. And he has also blocked new oil drilling permits on public land, which essentially restricts oil supply in the US going forwards, and is quite bullish for oil prices. As you will see when we go through the checklist, that UK inflation has picked up. But the one good news was that the UK vaccination programme continues to roll out, and we have hope that there will be an end to lockdown. So the one piece of good news this week was that Variant Perception have modelled the impact of the UK vaccination programme, and they are predicting that by mid-March, hospital admissions will be down by 50% and deaths down by 60%, which would be extraordinarily good news.
So I noticed today, Keith, the government is talking about whether they should close our borders entirely to all non-UK citizens. And that, I think, is because they're very concerned about variants that are springing up around the world to the coronavirus, which may be not affected by the vaccination that we're currently giving the population. And that's a very understandable concern, because there are these variants that have popped up in Brazil and South Africa, and there will doubtless be others that are arising around the world all the time. And it would completely, if one of those variations became the dominant strain in the UK again, it would completely negate the vaccination program. The difficulty with that is that it would have a seriously deleterious effect on, for example, the tourism and leisure industry and airlines. Presumably trade would continue, but you'd have to have some form of quarantining within the ports and airports where goods were coming in. So it's one to watch, but it's certainly not good news for the economy if we have this type of variant of coronavirus popping up around the world.
Well, if the government does implement those further quarantine measures, as you suggest, Richard, it will further delay the recovery in international air travel and be very negative for airlines and the travel agents.
Yeah.
Moving on. So this is a graph of US federal debt, and as you can see, it is on an accelerating path. So Janet Yellen was talking in the week. Janet Yellen is used to be head of the Fed and is now the US Treasury Secretary. So she was talking about trying to put the US on a sustainable fiscal path. And if you look at what the US government spent its money on in 2019, you'll see that it spent $375 billion in interest payments. And as interest rates have been very low in 2020, the net interest payments as percentage of GDP have been stable. but the amount of debt is rising very quickly. And in order for interest payments to remain a stable portion of GDP, interest rates have to stay very low. If they rise, then the US will have to spend an ever increasing amount on interest, which will mean it will have to cut in to its other expenditures. Now, Janet Yellen said there are 3 ways that the US could stabilize its interest rate payments and put the fiscal budget on a sustainable path. One of those was cutting entitlements and raising taxes, always deeply unpopular. The other was suppress interest rates and hurt savers. And the third was cut the defense budget. The defense budget is the only part of the US government expenditure which is discretionary. Everything else is mandated, is their entitlements.
So interesting, Casey. Obviously, the US dollar is the world's reserve currency. And one of the things that a world reserve currency needs to sustain it is a powerful defense. And all historic world reserve currencies have been from a country with a very significant military. So the UK, Portugal, for example. So I suspect cutting the defense budget for the United States is simply not an option.
Well, if you remember the book review I did in our first episode, Richard, we talked about you can suppress your own interest rates, but what you can't do is make foreigners buy a currency that they've lost confidence in. And so if the US continues to run an unsustainable fiscal deficit, I expect the US dollar to start accelerating its decline.
So you may be right, Keith. I don't dispute what you say at all. But so today there was news that the UK deficit for December was over £30 billion. And apparently the normal deficit in December is about 12 billion. There's also Rishi Sunak, our Chancellor, considering in the budget raising corporation taxes from current 19% to 23%, which is still 0.5% lower than the OECD average. And that would raise circa £14 billion over 12 months, which is just over half of the December deficit. So the numbers simply don't stack up.
Yeah, I agree. All the Western democracies are currently on unsustainable fiscal paths.
Yeah. So the next graph, I think, Keith, is a graph of US 10-year interest rates, which for the last 40 years have been on a gentle downward trend. And the US, if the US continues to issue more and more debt, then the interest rate, and they wish to maintain their government interest payments constant, then the US interest rate is going to have to approach 0, but it will never have to go below 0, the absolute interest rate. But of course, real interest rates, i.e. the interest rate less the inflation rate, could go markedly below 0. And that might now be the more relevant graph to look at, the graph of US real interest rates going into the future.
Yeah. So the Richard's point is that the interest payments that the US has to make are nominal ones, whereas so they can keep interest rates low, but if inflation rises, then they'll have very negative real rates, which will destroy the people's savings essentially.
Yeah.
Now the 30-year rate is rising. And the US is talking about issuing a lot of long-term debt. Now, if this continues rising, then they will lock in larger future debt payments, interest payments. So this is something to watch. Richard, do you want to talk about Bitcoin?
Well, Bitcoin is on a wild ride, Keith. So it went almost vertical from $30,000, having had a very rapid increase to $20,000. It smashed through the previous high and carried on going on a sort of parabolic path up to $40,000. and it has now lost. It's now $10,000 down, which is basically it's lost half of the increase it made from $20,000. I suspect that the rise was so rapid that this is simple profit taking and so forth, and that we haven't seen the last of this rise yet. And it's a white knuckle ride for anybody involved in it. And as ever, the caution is only have a small position if you want a position in it at all. And the next slide is Ethereum, Ether. And Ether has just breached its 2017 high there. If you remember, Bitcoin smacked through it and went up to almost twice the 2017 high. So Ether is following, but following more slowly. But also the pullback in Ether was less, proportionately, was less than that in Bitcoin. And the difference, my understanding, the difference between Ether and Bitcoin is that Ether has a real world use in smart contracts, right, and therefore has a functionality that Bitcoin doesn't have. And the question, of course, is Ether going to actually outperform Bitcoin going forwards or not? I don't offer a view, but I do think it's an interesting question to think about.
Well, as you know, Richard, I am a Bitcoin skeptic, but I don't think this is the peak. I think whenever you see an accelerating upwards move in an asset, basically people get sucked in, the speculators get sucked in, and you get this rapid acceleration to a peak, and then the short-term buyers get shaken out quite quickly when it fails to keep on going higher. And so you naturally get this short spike downwards.
Yeah.
And I expect that it to bottom out and keep on going. I don't think we're at the top. Anyway, so getting onto this week's checklist, both copper and iron were slightly down on the week, as was WTI, which has had a very strong rise over the last couple of months. Gold ended up slightly on the week, having had a very good day on the Biden inauguration. Bitcoin was the big mover, which was down 20%, as we've just said. The all share was down 1.2% on the week. The S&P 500 is up, but that obviously does not include today. So we're talking on Friday morning before the US has opened. The sterling was broadly stable, so really, frankly, not much to talk about there. Yeah. I am not concerned about the fact that the stock market has come off a bit in the last couple of weeks. Frankly, I think that is entirely seasonal, as you can see from this seasonal chart of the S&P 500. We generally get a January sell-off. When we look at rates, I think the thing to talk about here is, well, that UK interest rates have continued to drift up slightly, but there was quite a big pickup in inflation. So RPI in December was at 1.2%, which is a 0.3% increase on November, and CPI increased to 0.8% from 0.3% in November. So CPI was up 0.5% in a month. Now, obviously, if that continues, then CPI would rapidly reach its the Bank of England's 2% target. And I'd also say that all those inflation rises occurred during a period when the UK economy is not doing very well at all. Yeah. So something to watch.
Yeah.
Okay, so shall we move on to our personal portfolios with Richard?
So my portfolio review, down a very small amount this week, 0.1%, due to my shares in precious metals bouncing up, and then my cryptos bouncing down. So quite volatile, but no great ultimate change. No new trades during the week. I did note that Pensana, the rare earth mining company, is being voluntarily delisted from the Australian Stock Exchange. Now, I don't know why, and their announcement said that they would explain the reasoning for it once it's happened, but I suspect it's maybe to do with costs. But the share price of Pensana has taken a bit of a whacking, and that's probably due to people being unnerved by that delisting from Australia, and possibly.
Well, presumably, Richard, the Australian holders have to sell their shares.
Exactly. Yeah. So that's possibly artificial. So I'm just hanging on. It is. If you're a chartist, it's interesting to notice there's an island here, and islands are always quite vulnerable to being filled. So I think that's the correct terminology.
Well, I will try and actually have a look at Pensana during the week. Because I don't hold any, and that might be an opportunity. So I will try and do some digging.
Or it might be an opportunity to say, thank goodness I don't hold anything. So found this chart of lithium carbonate. So the price is currently about 1/3 of what it was in 2018.
Wow.
But you will see that it is starting to rise quite rapidly. So if it continues that rise, that bodes well for the lithium miners. And this is Zinnwald Lithium, which I have shares in. And I think you have, haven't you, Keith?
No.
No. Okay. So it's if the price of lithium continues to rise, I'm hopeful that the price of Zinnwald will continue to rise.
Mm-hmm.
This is a graph of the US real yield. Obviously, Keith talked about that earlier, or the US yield, but the real yield on the US 5-year is now minus 1.7%, which means that anyone holding the US 5-year is losing money against inflation each year. And this is the Bank of America Global Fund Manager Survey, which says that inflation expectations are at an all-time high.
Yeah. All this tells me, Richard, you should stay long gold.
Yes. Yeah, that and the real interest rate.
Yeah.
And I picked this article out from the Financial Times. In New York, to build miles of new power lines in renewables push obviously needs to get high voltage power into New York in order to drive the electrification of transport and so forth. And by building hundreds of miles of new high voltage power lines, that is clearly going to use a lot of copper. Now, I guess New York building power lines is fairly insignificant in the world copper market, but if every large city in the world follows suit, then you get a very significant upsurge in demand for copper for building high voltage transmission lines. And that's my update, Keith.
Thank you, Richard. Okay, so my week was considerably worse than Richard's. I lost 2.6%, which left me only up 1.1% on the year. Now, I hold a lot of cyclicals, so I hold a lot more oil than Richard does.
Yeah.
But as we discussed earlier, this is a normal January sell-off, and I'm singly unfussed. So I did no sells, but I did do some buys. Buys in stocks I hope you have watched our videos on. So I topped up in Goldplat, whose share price has been coming off. And I noticed the CEO is talking to investors next week, and I should be listening. I bought some more Tecmar. Tecmar had a couple of contract wins, which bodes well for the future, both of them in the offshore wind sector. And I also had one of my limit orders in Pharos Energy hit. And this is one of the problems of putting in limit orders, in that I put in a limit order just below where the share price was in the market, expecting the normal January sell-off to take it down so I could pick some up cheap. And the company then did a private placement 10% below current share price. Share price tanks by 10%. I get hit.
So your limit really should have been, your new limit would have been 10% below the point at which you got hit, roughly speaking.
Yeah.
I have to confess, Keith, I've made a mistake. I bought some Tecmar. I didn't put it in my buys, so apologies for that.
Well, we're both in it together. I think that it's going to be a multi-bagger over the next 5 years.
Keeping my fingers crossed that you're right, Keith.
And I think that is it for this week. Thank you for listening. We will be putting out some further individual stock share talks this week, and I hope you'll catch them when they come out. Please, can you press like and subscribe? And we hope to see you again during the week. So it's goodbye from Richard Wheater.
And goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.